Hello guys, so here is a question on amalgamation and partnership, that is between Ade, Bola and Collins. Ade and Bola carried on business in partnership as printers, sharing profit in a ratio 3:2. The balance sheet as at 31st December 1996 shows the following position. So this is the balance sheet for Ade and Bola. We have capital account to the debt, current account to those values, their assets, their fixed asset and their current assets. So Collins was also in business on his own as a retail stationer, and at the same date, his balance sheet was as follows. So this balance sheet is for Collins. We have the current capital account, sundry creditors, the fixed assets, and his current assets, which are these values here. So the next information is that the profits of the respective businesses for the past 5 years had been, so the year ended for Ade and Bola and for the Collins. So these were the profit that they made. So 31st of December 1992. These are the profits for Bola and Collins. 1993, 1994, 1995, and 1996. These were the profits that each business made before the amalgamation. So Ade and Bola were already in partnership already. Collins was doing his own sole business alone. So it was agreed that on 31st of December 1996, the two businesses should amalgamate on the following terms. 1. The valuation of sundry debtors, stock, work in progress, and motor vehicles were accepted at balance sheet figures, but all other assets were to be revalued. 2. Goodwill to be valued at 3 years purchase of the average profit for the past 5 years after deducting proprietors' remuneration at the rate of 60,000 naira per annum each. 3. Capital account was to be opened for each partner for 700,000 naira. Any balance to be treated as current account. 4. The freehold property was valued at 750,000 naira. Leasehold properties at 250,000 naira, plants and machinery at 320,000 naira, and furniture and fittings each case at 50% of book values. A. Prepare the revised balance sheet of Ade and Bola and Collins as at 31st December 1996. B. Prepare the opening balance sheet of the new firm. So here is the computation of the revaluation account. So we have something of this nature. We have the column for Ade and Bola and for Collins for both the debit and the credit side. So revaluation account is a type of account which is prepared. So revaluation of assets is an action required to accurately describe the true value of capital goods a business owns. Yes, it is used to check the exact market value of the asset so that you don't have to run on a loss. So number 1, revaluation account. So on my let's get started. So for the furnitures and fittings, so in our balance sheet in the question, we were told that the furnitures and fittings for Ade and Bola is 86,000 naira. So whatever information I have in my balance sheet will be my balance brought forward when opening each of the ledgers of the assets. So remember, it was stated that in the additional information that the valuations of sundry debtors, stocks, work in progress, and motor vehicles were accepted at balance sheet figures, but all other assets were to be revalued. So it simply means that when we are dealing with our revaluation account, this asset that we mentioned will not be there, and it is only this assets for additional information for that will be in the revaluation account. So like I said, whatever you have in your balance sheet is going to be a balance brought forward, because normal our furnitures and fitting is a fixed asset, and all fixed asset has a debit balance. So I'm going to write my balance brought forward, which is 86,000 naira. So my balance carried down. So it has been stated in the additional information that furnitures and fittings in each case at 50% of book value. So in our workings here, workings 1, so it means our furniture and fittings for Ade and Bola is going to be 50% of 86,000 naira, which should amount to 43,000 naira. So 50% of 86,000 naira is 43,000 naira. So the revaluation for furniture and fittings is 43,000 naira. So my revaluation is going to be 43,000 naira, which is workings 1 for Ade and Bola. So since my credit side is lesser than the debit side, so automatically my balance carried down will be here. 43,000 naira. That will be 86,000. 86,000. So because the revaluation is on the credit side of the furniture and fittings account, it should come to the debit side here, because for every credit entry there must be a corresponding debit entry and vice versa. So here will be furnitures and fittings for Bola, that is 43,000 naira. For Ade and Bola, excuse me. Then for Collins, furnitures and fittings for Collins, this is for Collins. So in the question we were told that the furnitures and fittings for Collins was 48,000 naira. So it's going to be 50% of 48,000 naira, which should amount to, when I use my calculator, that should amount to 24,000 naira. So here is the ledger of furniture and fittings for Collins. So like I said, our fixed asset has a debit balance, so balance brought forward, which is the figure coming from our balance sheet for Collins in the question, is 48,000 naira. Then the revaluation value is 24,000 naira. So I'm going to write revaluation, which is workings 2, that's 24,000 naira. So the credit side is lesser than the debit side, so the difference will be my balance carried down, which is 24,000 naira. So when you calculate everything, that will be 48,000 naira. Don't forget your balance brought down, which is 43,000. Balance brought down is 24,000. So like I said, because the revaluation is on the credit side, it's going to have a corresponding debit entry, which is on the debit side. So the Collins value for furniture and fittings is 24,000 naira. So the next one is the freehold property. The freehold property for Ade and Bola from the balance sheet is 419,000 naira. So this is for Ade and Bola. There will be balance brought forward 490,000 naira. So it's been given in the question already that the that is freehold property. The freehold property was valued at, excuse me, the freehold property was valued at 750,000 naira.